In this video, we are going to take a look at some of the common principles associated with valuation of common stock. As you know, the value of any financial security is essentially the net present value of all the expected future cash flows. Now, in the cases of bonds or preferred stocks, it is pretty simple because we know what the associated cash flows are. Now, in the case of shares or stocks, we also know that we are going to receive dividends or we expect to receive dividends. But the problem arises in determining when those dividends will be paid, how much, and for how long. This problem arises because in common stocks, dividends are not fixed and not guaranteed. Additionally, even if we try to make an educated guess about dividends, there's an added problem that the pattern of dividend varies dramatically between different firms. Even though generally speaking, dividends tend to increase as the corporate earnings or the operating profit of a company grows. So a company that makes more money is also likely to disperse a greater amount of dividends. It's just that we don't know how much or to what extent. So in the case of these companies which are growing, there's also an expectation by investors that their dividends will continue to grow. So that brings us to an interesting question. How can a company grow? Well, if a company is relying on an existing base of capital, it really doesn't have a lot of room to grow. So essentially, by infusing or adding more capital, by injecting more money into the company, we are allowing the company to grow more, to grow faster. So where does this money come from? Well, there are several ways. We can borrow that money, which would give us debt. This can be from commercial banks, can be through issuance of bonds, or we can bring in new owners or more owners. This is by issuing common stock. We're raising money from the market by telling the people who are giving us the money, take a slice of the ownership of the company. In return for that, give us some money. So this is a way of growing by adding up extra capital from outside sources. So this is external financing. It is also possible for the company to grow through internal financing. So how does that work? Remember that the company is operating every year and is generating profit. There is no obligation that the entire amount of profit will have to be given back to the owners as dividends. It is also possible that the management would decide to retain some of that profit and reinvest that into the firm. So this is another way of financing the future growth of the company, and is likely to have a positive impact on the future value of the stock. So these are some of the issues that we should consider and try to understand before we get into the nitty-gritty of valuation of a common stock. So related to this, let's try to understand three concepts. The G, or the growth rate. The G, which is very common in valuation formulas, is the growth rate of future earnings and the growth in the common shareholders' investment into that company. ROE, which is a common accounting ratio, stands for return on equity. So it's a ratio where we have the net income after tax divided by the shareholders' book value. Lastly, the profit retention ratio tells us what proportion of our annual earnings we are retaining to reinvest back into the firm. In other words, what portion of our profit we are not giving out as dividends. So once we understand these concepts, we are ready to go ahead and value a stock. So as you understand, the value of a common stock is going to be the present value of all the expected future dividends. The formula that you need to really understand and remember is the one on your screen. It is D1 divided by R minus G. The one subscript is the tricky part here. It is dividend in 1 year from today. So dividend in 1 year from now Whatever dividend that we just had, or the most recent dividend, you should always remember that as D0 or D0. So it is the last dividend issued. And D1 is the dividend that we expect to receive. I repeat, we expect in 1 year from now. The R is the required rate of return by the investors, and the G is the growth rate. So let's consider this example. A company paid $1 as dividend at the end of last year, and we expect the company to pay a cash dividend in future. We anticipate a growth rate of 5%, and the investor's required rate of return is 10%. Here we know the D0. So the last most recent dividend was $1. The way we arrive at D1, which is what we need for the formula, is D0 times 1 plus G. Similarly, we can also compute D2. D2 equals D1 times 1 plus G. D1 equals D0 times 1 plus G. So that gives us $1.05. We know that the required rate of return is 10%. So we plug the information into the formula, and we know that the price of the share should be $21. Remember, I said it should be $21 because the market can disagree with that. But anyway, this valuation model, the dividend valuation model, gives you a rough idea of what the value of the company should be. Once you arrive at that computation yourself, you can compare that with the market traded price and determine by yourself whether or not you should invest in that company. If you think that the share is overvalued, do not buy. If you think that the share is undervalued, sure, go ahead and buy. This might be a bargain for you.